Right then, good morning everyone as we head into European trading on Thursday the 6th of July. We'll just look into markets and see what is going on after we have had the minutes over the course of yesterday evening and some updates on the situation regarding the US and China, where there is a bit of a spat brewing between China and the United States. Janet Yellen prepares to go to China, to speak to some Chinese officials. But on the eve of that, the Chinese have come out and they have restricted metals exports that are used in semiconductors, also stating that this is just the start, probably in retaliation to Joe Biden's comments about President Xi Jinping being a dictator. Obviously, we said in these videos a couple of weeks ago that is not likely to be taken well from the Chinese, and that seems to be the case. So how much further they go in terms of kind of raising tensions between themselves and the US obviously remains to be seen, but that is the first step, they say. How far that goes, I don't know. So the actual comments a couple of weeks ago didn't make too much of an impact on markets, but we did suggest that if that brews and that continues, and then something like this does happen off the back of it, that is what will get markets moving. That's what we're seeing a bit of in trade this morning, a bit of negativity across sentiment throughout the Asian session, which also goes in line with the minutes from last night. Now, the minutes did state that nearly all Fed officials were unanimous in not raising interest rates, but they were also nearly all unanimous in the fact that they are probably going to have to tighten policy further. They are going to have to tighten policy further in order to cool down, obviously, inflation that is far too high for the country to be able to deal with in a sustainable fashion. The US economy is predicted to stay resilient as it goes on through the year, so they still do have room to raise interest rates in order to cool down inflation without denting growth too much. So expect some further interest rate hikes, which markets are probably slowly coming around to the fact that is likely to happen. The last meeting, their last interest rate decision, markets didn't really seem to care about it and said, nah, you're not going to do that. As they say, don't fight the Fed. So we're likely to see an extra couple of interest rate hikes. There's now an 85% chance of a 25 basis point hike at the next meeting, which money markets are currently pricing in, and then yields have pushed higher over the course of the last number of hours since the minute. So markets pricing in higher interest rates largely priced into the next meeting. How much more interest rate hikes to come still remains to be seen, but Jerome Powell did suggest a further 50 basis points worth of hikes. Definitely we'll see 25. He did not rule out back-to-back rate hikes, and that does not seem like it is a complete no-go. You'd imagine they probably will continue to tighten, and do we get an extra two interest rate hikes in a row? Do they do one, pause, and then another? We'll have to see, obviously, as it comes around to it. But 85% chance of a hike at the next meeting goes in line with what they've been saying. Minutes confirmed that into last night. And apart from that, we've not really got a lot to go off in terms of fresh headlines. Obviously, the US-China tensions plus the minutes last night caused a bit of a negative mood heading into markets this morning, which you can see here across the grid. You can see US equity futures, European equity futures, Asia Pacific equity futures down across the board. You can see US bonds being sold with yields higher across the curve, which is obviously off the back of interest rates rising. Now, I think something of note, this 10-year and this 30-year, the 30-year has been higher than the 10-year for a substantial period of time, but now the 10-year yield is higher than the 30. So we've had an inverted yield curve for a while. You can see the 2-year yields 4.96, 3-year 4.63, 5-year 4.27, 10-year 3.96, and the 30-year yield at 3.94. Right, so that is now the 30-year yield below the 10-year, which again further inverts the yield curve, which obviously is a signal for an impending recession at some point in the future. Global bond yields across the world mostly higher, going in line with the hawkish stance from the Fed and the hawkish stance from the majority of central banks around the world. US dollar is sold off the back of that, which is maybe slightly surprising. You expect to see US dollar strength off the back of that, which we did have a bit of yesterday post-release, but certainly over the course of this morning, you've had a bit of a pop to the downside in the US dollar, which we'll have a look at once we get over to some charts now in a minute. Now, the Australian dollar, Kiwi dollar are not really going in line with that. The Canadian dollar's, down across the board, as you can see, but, expect to see a red across the equity markets. You'd expect to see a red across Aussie, Kiwi and CAD as well, which is not really what we're getting at the moment, but you can see the Japanese yen strong across the board. So this negativity in the Asian session proving supportive for the Japanese yen, but as you can see, it is the worst performing currency in terms of month to date, in terms of 3-month percentage change, year to date percentage change. Really is the weakest currency across the board. So a bit of a bounce back in that. Plus you're up near 145 on dollar yen, as you can see across here. It's back down at 143.70. I did touch off 145, and a bit of a bounce off that, as we were alluding to in other videos, is not completely unsurprising, to be perfectly honest with you. I was never going to break it initially. The markets have respected it. No need for central bank intervention just yet. Round to the calendars, we can see the minutes last night, which we spoke about over the course of last night. In terms of today's calendar, we do have some jobless claims out of the US at 1:30. Gives us an indication of how the labour market is performing over the last week in terms of claims for unemployment benefits. Obviously, we've got NFP and the unemployment rate tomorrow, which do take centre stage in terms of the labour market. So in terms of jobless claims, we can look at that. Obviously, if jobless claims rise, well, then that could be a precursor for NFP tomorrow, or a slight precursor for NFP tomorrow. But does it really get markets moving too much today when we got that out tomorrow? Possibly not. Maybe in another week it'd be more worth our while having a look towards that type of thing. But consensus 245 today, so anything above kind of 260, 270 would be seen as a right negative. Get down towards 200, that would obviously be a positive and give some sort of a handover into tomorrow. Apart from that, you're not really got a great deal out. You got some retail sales out of Europe, which is obviously consumer spending within the Eurozone economy. If consumer spending can remain resilient in the midst of this cost of living and inflation issue, that is obviously a positive for the economy. But if that dips back into negative territory, it's just further negative data out of the Eurozone, where we had negative data yesterday in terms of these PMIs. We've had some negative data in terms of the manufacturing PMIs out of Europe on Monday. So we've had a bit of negative data out of the Eurozone over the course of this week, which has been replicated across the DAX. So if we have a look at that retail sales, 10 o'clock might help us provide some further impetus into some trading decisions. We can see the DAX over the course of this week selling off aggressively. You can see the FTSE selling off aggressively, the Nikkei selling off aggressively. The US stock indices have held firm over the course of this week, apart from the Russell, a better gauge for the health of the US economy. See, with it taking a lot more companies into consideration, it's a much more broad-based view of the US economy. So we're talking about a potential recession with that yield curve. Okay, it's supposed to remain resilient over the course of this year, which the yield curve does suggest in terms of the kind of 1 month, 3 month, 6 month yields. But as we dip into next year, as we get into 2024, that's when the economy is decided or expected to somewhat lag, and that is a negative for the Russell. So if you're hearing chatter about, if you get into some chatter about the US economy being in trouble, the Russell is the one to play. Apart from that, you'd probably just rather stick with these. But obviously, you had Monday and Tuesday, which are low trading, low volatility, low liquidity. Should I say low liquidity in US markets with the Independence Day. So yesterday was kind of a Monday in the US. Get into today. Some people will have taken yesterday off as well. So really, it's a bit of a tricky week in terms of the US indices, but you have to imagine the bias is clearly pointed lower across these stock indexes, with the DAX, the FTSE, the Nikkei doing this. You see the S&P, the Dow, the Nasdaq are still lower, plus the Russell lower as well. So a bit of negativity no matter where you look across the board in stock indexes. Now you can see a bit of weakness in the US dollar, and you can see Aussie popping higher, Kiwi trying to pop higher, Euro popping higher, Sterling popping slightly higher over the course of this morning's session. Dollar Swiss down lower, dollar yen kind of having a bit of solid downside over the course of this morning, in line with that Japanese yen strength. Canadian dollar starting to move lower over the course of the last hour. Dollar index as well. Now, hawkish minutes from last night would suggest potential upside for the US dollar, which is a slight bit of a slight bit of uncertainty surrounding that, but maybe the fact that these US-China tensions are raising their head, maybe that's a reason for some negativity in the US dollar. So that's interesting reaction to some stock downside yesterday. For the US dollar to have downside today again means that markets, or that would suggest to me that markets have not thrown those US-China tensions out the window, that they are listening to them, and there's potential for that to continue and to rear its head again. So let's see how that plays out. But a bit of a strange reaction to the US dollar this morning, especially with equity downside. Look at bond yields. You have bond yield upside, so 10-year, 2-year pushing higher. You've got equities pushing lower. That's probably an environment where the US dollar should push higher. So for me, interesting moves that I'll keep an eye on over the course of the next trading sessions. Maybe that is due to some tensions between the US and China. Maybe markets do not like that for the US dollar. But back onto this, you can see a bit of Japanese yen strength against Aussie yen, CAD yen, which obviously we've just spoken about. Oil continues to grind higher. There's an article about oil having downside back on Reuters off the back of supply chain. Not off the back of global demand issues with negative data over the course of this week, but doesn't really seem that way to me. Over the course of this week, it is grinding higher, albeit not by much aggression, but it does still grind higher and moves further away from that 67 round number, which would have been nice if we had a break off of that, break out of that. But we're back up at 72 at the moment, and that does look like it wants to have another attempt higher. But yesterday's session, we were speaking about some gold downside. Yesterday's video, we were speaking about some gold downside off this 1930 level, which we did get, and we got a solid $20 move lower. We have broken through this level of support that we were looking at 1920. We'll come back. We're looking at retesting into this region here. Is that an opportunity for another short again today? Obviously, reasons that we posted, or reasons that we spoke about yesterday. Maybe there is some potential for some further downside, but decent bit of a move yesterday. Hopefully, I managed to catch it, but maybe there's another opportunity if that continues lower. A bit of a triple top broken out through your neckline. Do we get a bit of a move lower back towards 1900? Let's see how that pans out over the course of today. But US dollar weakness certainly does not go in line with this move lower. If the US dollar does turn around and starts pushing higher again, that should be a good one to look to try and trade. But keep an eye on those jobless claims later on this afternoon. You got a services PMI out of the US at 3 o'clock. They'd be the main focus of attention on the economic docket this morning, or over the course of today. We do have non-farm payrolls, the unemployment rate tomorrow, which we'll update further when we get around to it tomorrow.